Hello, my name is Ciro Ulinski. I am a final year MBA student at NJCU. I've been at NJCU for 4 years. The first 2 years I did my Master's of Science in National Security Studies, and then I've been a MBA student here for the last year and a half. First semester I was on campus. The last year I've been taking as many courses as I could online, and because I'm just coming back from my deployment overseas, been there for 9 months. Literally just got back 3 days ago. So doing this project during the demobilization process was definitely a tough task, but I am very glad that I was able to do it because I got a lot of knowledge about this company as well as the ratio analysis and the rest of the report. Definitely something that I gained a lot of knowledge from. So to start off, the company, a little about Southwest Airlines. Southwest Airlines. It's been around. The concept came about in the 1960s. So the concept was brought about to be a low airfare with exceptional customer service. Basically, the low cost as well as the exceptional customer service aspect, which wasn't the main focus in airline industries, and that's what keeps Southwest to this day as one of their distinguishable facts, along with the low price pairing, which they've been able to maintain since the 60s. So it started off with the triangle of flights destinations between three major cities. They were very selective, which from the beginning shows good investment into the flight routes, the equipment, everything they need to breach the market with three major cities: San Antonio, Dallas, and Houston. So out of all of the reports, every year Southwest boasts that since the 1970s until current years, they've been the only domestic and airline company to be profitable progressively throughout their expansion. So the company currently offers point-to-point travel, much more destinations than that original triangle, over 80 domestic and 14 near domestic, and currently they are starting to explore near domestics. That means Caribbean, different areas in the near domestic, imagine that, and Hawaii. They have plans for international growth, which could in turn grow their operations beyond the solely being a major competitor in the domestic airline industry, but also grow if they are able to balance their operations into a major competitor in the international field, which may take a while. I'll touch on that in a little bit. They also offer air cargo services, which make up a slight percentage of their overall operations, but the main revenue that they receive is from passenger flights. All right, so I'm going to briefly go through the strengths, threats, risk factors, and I did all of the analyses. I'll just touch on them very briefly as I go through. So the strengths, since the beginning, they've been industry leader in customer service. They offer a large and growing number of domestic locations, and most of all, they are a well-established name in domestic airline industry. They're recognizable and they're a trustworthy brand. So the thing about Southwest is that they have an all Boeing fleet. By all Boeing fleet, I mean that all of their aircrafts are Boeing aircrafts, over 750 aircrafts. As highlighted, that saves on repairs if they need new modifications. It's easier to implement those modifications inside. Drop down on operating expenses that could estimate fuel cost estimation for yearly budgeting, etc. So that all Boeing fleet, that is a strength in a sense that it can save that company in certain areas with those savings. So threats, alternatives to the airline industry, that means you have traditional transportation routes, and being that the company relies on passenger revenues, if there's an economic downturn, say the car, bus, train industry might be an alternative. You never know. Technical alternatives, so just like this video, why would I take a plane to go to New York City from California using Southwest to give a brief or a presentation? I could use video conferencing. That's definitely a threat as technology improves. well-established industry competitors. We'll see the benchmark company Spirit Airlines in this, and if they plan on going into the international market, definitely have to consider the pre-existing international competitors. Regulatory changes and fuel costs. By that I mean fuel costs can rise, they can fluctuate just as well, and more regulations might hurt the operations because it might halt operations for a certain amount of time. Risk factors, economic fluctuations, like I said, might affect the amount of passengers because as you'll see in these statements, the Southwest is heavily dependent on passenger revenue. Labor costs and expenses labor costs will increase operating expenses. Has the potential to. Just another threat. So briefly, going through each of the ratios we conducted. So first will be the profit margin, the earnings per share, return on equity, return on assets, quality of income, fixed asset turnover ratio. All right, so the profit margin, if you look at the numbers, it seems as if the profit margin measures the percentage of net sales that are turned profits. The higher the profit margin, the more profit is generated per dollars of sale. So since 2014, Southwest, they've remained relatively comparable to Spirit, except for the latest 2 years in 2017 and 18. In 2018, Southwest outperformed Spirit, but both companies fell since 2017. Which correlates to the net income for both companies. But for 2017 2018, Southwest's profit margin only dropped 5%, and the company not affected nearly as much as Spirit, which dropped 11%. All right, we'll move on to the earnings per share. So look at the numbers. So earnings per share, real quick. If a company has a higher EPS, the company can be considered more profitable. So looking at these ratios, Southwest, they had a trend of lower EPS than Spirit from 2014 to 2017, but both companies were able to steadily increase their EPS during 2014-2017 period steadily. So similar to Spirit, Southwest, they showed a steady increase in EPS from 2017 to 2018. Something might have occurred in the overall airline industry as a whole. The average number of shares of common stock outstanding remained pretty similar, but the decrease in net income from 2017 2018 can definitely be seen in this trend. ROE, return on equity, earnings per equity, both companies, they showed steady increase in ROE, even though both companies dropped from 2017 to 2018. Southwest declined, but not nearly as much as Spirit once again. Southwest, for the return on assets, you can see that the ratios, we use the ratios. Southwest, they had lower ROA in 2014 and 15, but Spirit's steadily declined from 2016 to 2018, while Southwest was finally able to breach and maintain a consistently higher ROA. And by 2018, Southwest had an ROA nearly 3 times Spirit's. All right, quality of income. Quality of income is going to measure the quality of income generated by cash. So ratio over 1.0 is high quality income. Ratio less than 1.0 indicates low quality income. Southwest and Spirit, they both had exceedingly high quality of income from 2014 to 2018, but Southwest almost always had consistently higher quality of income from 2014 to 2017, just not 2018. The fixed asset turnover, so for the flight equipment, ground equipment, as you can see here, I've listed from 2014 to 2018, Spirit had a higher ratio, 2014 to 2016, but by 2017, Spirit's ratio continued to decline and was again surpassed by Southwest. All right, we're going to do these ratios next. Liquidity test, current ratio, quick ratio, receivable turnover ratio, inventory ratio. Quick ratio is a useful company. We'll start off with. All right, I'm gonna go through these real quick. Go back and look at them slowly. I really wanted to get to the debt to equity to the where is it? Operating expense ratio. So the lower the operating expense ratio, the better. The Spirit Airlines had significantly higher operating expenses in 2018 than in the years prior. Meanwhile, Southwest only had slight increases in operating expense, which helped better balance out the operating expenses to total revenues. Real quick, the debt to equity ratio. Higher ratio is that the company is a high risk investment. The lower ratio, the better the ratio. So Southwest, they've been able to steadily decrease the debt to equity ratio for the past 5 years, despite the increase from 2017 to 2018, which seemed to have significantly affected Spirit as well. May have been a shift in the airline industry as a whole, as indicated by both of the companies having significant increases in debt to equity ratio from 2017 to 2018. All right, for the looking at the common size income statement, absolute and relative change should definitely be noted for the incrementally increasing trend. Due to the nature of the airline services, as you can see, Southwest incurs heavy operating expenses, even though the company has, over the past 5 years, so one of the major advantages of Southwest is the company relies on its all Boeing aircrafts, which allows the company to remain steady, increase in operating expenses, only subjected to whether the company adds new aircraft to the primarily subjected to whether the company adds new aircraft to the fleet, correspondingly increasing aircraft or flight routes, correspondingly increasing the flight routes, operating expenses, and revenues. More customers served. Pause this anytime you want. The PP&E make up the majority of Southwest's overall assets, as you can see. The company, they bring in new aircrafts. In the news, Boeing 737 MAX 7 is one of their new investments. It's a larger aircraft. It is servicing more customers. Might be a player for the international travel expenses. So that's just something to consider, that they rely a lot on their assets, their PP&E primarily, for their operations. All right, so the DuPont analysis, while we get to this, so the DuPont analysis, so let's go right to the ROE. So it fluctuates from 2014 to 2018. Notably, the ROE increases from 7% in 2016, 2017, and further negatively impacted the company's 8% leverage from 2017 to 2018. In evaluating the ROE from 2016 to 2018, the fluctuation seems to mostly be affected by similar trends in the profit margin. If you look at the two, they seem to follow a very similar trend in the profitability. So recommendations, I definitely recommend investment into the company. So the company, even in some portions of the ratios, if you go back, you'll see that both Southwest and their benchmark company were affected in 2016 or 2017, 2018, but Southwest was not affected or did not drop as much as Spirit, which is a benchmark company in the industry. And moving forward, I would definitely say that the next step would be evaluating the 2019 reports to see if the declination trends continue, or examine a third company. But overall, the company has been able to maintain profitability for 47 years, as it keeps boasting in most of the annual reports, and it seems they have many projects going on, such as international expansion, which may take a while to build up steam, but once the company is able to get a foothold and become major competitive, they can use that brand name and profitability to gain the international customers' trust. Might take a few years. I would definitely